Friday's cooler than expected CPI print is boosting expectations for the Fed to trim rates by a quarter point at this week's meeting. Joining us right now is former Cleveland Fed President Loretta Mester. She's also a CNBC contributor. And Loretta, what do you think? The numbers were a little weaker than anticipated, but you're still looking at inflation up better than 3% on a year-over-year basis.
Yeah, Becky, thanks. Good morning. You're exactly right. And if you looked at the headlines coming out after that report was released, you saw both. You had some saying, great, it's not 3.1, it's only 3. And then you had others saying it's 3, it's above 2%. So I think that kind of clarifies, where people are and sort of how they're thinking about it. Look, the CPI report for September is not going to dissuade the Fed from cutting 25 basis point at the meeting. But, it really isn't a strong case. You do have employment weakening and risk to the downside on that part of the mandate. And you have the government shutdown effect on federal workers being a new factor for this quarter. So I think the Fed will take another insurance cut. But inflation risks are still to the upside. And I think we shouldn't lose sight of that. And the Fed shouldn't lose sight of that part of the mandate. It's really important for them to keep both of those, employment and inflation, in mind, because 3%, is still well above 2%, the goal. They're going to have to keep policy a bit restrictive if they want to get back to 2%, which I know they're aiming for. And we've learned in the post-pandemic period that you shouldn't put all your view in one scenario. You really have to be looking at the possibility that inflation will be very stubborn and you're going to need to use policy, monetary policy, if you want to get back to 2%. So it's basically not putting all your eggs in one basket for the economy and keeping policy well positioned to hit both parts of the mandate. And I think that's the job that's before the Fed at this point. Very complicated situation because you don't have as much data as you might usually have. But they're going to have to keep their eye on both parts going into this meeting and the rest of the year.
The inflation running above 2% is not some new phenomenon. It's been 4 years that it's been running above 2%. Yeah. Should we just say, forget it, we are no longer really targeting 2%? We've moved the goalposts?
Well, that would be a big mistake. I mean, one of the things that helped during the post-pandemic period was the fact that people did believe that the Fed would do what it takes to get back to 2% over time, not immediately, but over time. And if they start undermining that view, and we've already seen that in surveys. If you look at the Cleveland Fed does a survey of firms' expectations, and they ask once a year, what do you think the Fed is aiming for? What is their inflation target? And it went up this year to 2.6. So that's not very comforting. And you want to have people believe the Fed's going to get back to 2%, because if they start not believing that, they will start acting as if inflation is going to remain high and be even higher. And that'll make it just even harder for the Fed to get back to its goal. So again, I think the Fed has to be very careful here. It may be the most likely scenario is that tariffs will, just raise the price level and then inflation will start moving back down. But the other scenario is it's not all tariffs. If you look at service inflation, taking out housing, that's been actually moving up a bit this year. And so I think they have to be very cognizant of the fact that even if they believe it's most likely they can look through tariff-related inflation and inflation will move back down, they're going to have to make that so with their monetary policy. And so they should be very careful here not to cut too much too quickly and get policy in a bad place, as when I was on the Fed, that's what happened during the post-pandemic period. And then we had to really tighten very aggressively. We don't want to be in that situation again, where the Fed has to reposition policy in a more aggressive way than is probably desirable.
Loretta, the Treasury Secretary was defending some of the, I guess, how the numbers actually look, saying that if you cherry pick certain things, inflation looks actually worse. There's something to that. I mean, gasoline prices are definitely down. That could have that could trickle through with oil prices, and food prices. I think at the grocery store, 1.1%. I think he said. Shelter and other issues. The way that it plays into it, is it possible that some of the numbers we're looking at are overstating where we are. Where also tariff inflation
overstating inflation.
Yeah, overstating inflation. Even they haven't seen it in the tariff sector side of things yet, according to the Treasury Secretary. So what's in there that could be maybe not cured by monetary policy? If the employment picture weakens, couldn't some of the service inflation start coming down?
Well, certainly if the economy weakens appreciably, you probably will get inflation moving back down. But we kind of would rather have it move down because monetary policy is set a little bit restrictively, have the employment picture, keep where it is and not deteriorate and have inflation move back down. And I think you're very true that one scenario is that this all will move back down to 2%. Basically where policy is now. But I think you have to entertain the possibility that if you look at services inflation, right, some of that has been very sticky. And that's the part where the Fed will have to be very cognizant of. They don't want that to start moving back up again. Some of the numbers since this, summer have been moving up. And so they have to be very careful. But you're right. There is a scenario where things go back to 2% once we get through the tariff shock and once stabilization in the labor market continues, we get back. But don't put all your eggs in that basket is what I'm saying, is you got to entertain other scenarios.
Which are much cheaper, which are down,
exactly.
down 58%, those eggs in your basket or something.
Yeah. I just think that it's better to look at various scenarios and not just assume one narrative is the correct narrative. Right. We did that during the pandemic, saying that it was going to be transitory, and it wasn't transitory.